Good morning and welcome. Thank you for joining. We have a great session today. Just wanted to take a few minutes to introduce myself, the panelists, and Schroders Personal Wealth. So for those of you who have not heard of Schroders Personal Wealth, we're a financial planning company with a key core mission to help improve the financial lives of everybody across the UK. So we're a relatively new company. We're backed by two parent companies, which hopefully you would have all heard of, so Lloyds Banking Group and Schroders PLC. So we can bring you all that great experience and heritage via Schroders Personal Wealth. So I'm Maria, as Louise mentioned. I'm one of the advisors here at Schroders Personal Wealth, and I'm joined by three of my colleagues on today's call, and we work from the Cambridge hub. So we have regional hubs located throughout the UK, so you'll ensure that you'll always have an advisor local to you. So they'll introduce themselves as we go through this morning's session. In line with today's session, we're ending towards the end of February, so with tax year end coming up. We wanted to do a session to really highlight some of those key considerations and things that you should be thinking about in your own lives, but also around your family, your loved ones, and maybe even your colleagues, depending on where you work. We want today's session to be as interactive as possible, so please do use the Q&A, the chat function, to submit any questions, and we will cover off as many as we can towards the end of our session today. So in terms of our session on our agenda today, so we're looking at top tips really to help you be tax end year ready, as well as how to create your own personal financial plan wherever you are on your journey, and what support is available. So without further ado, I'm going to hand over to my colleague that I work really closely with, Darren, next. Thank you.
Thank you, Maria. Good morning, everybody. And my name's Darren Locker. I'm, like Maria, one of the advisors that work out of the Cambridge Hub office. So my session, or my part of today's session, is going to look at some of the tax year end allowances that are, well, not necessarily tax year end, but tax allowances that are available for you before the end of this tax year. The ones we're going to talk about will either give you tax savings or they will give you some tax back in one case. Most of the allowances that are available are of the use it or lose it variety. So what that means is if you don't make use of it before the end of the tax year, then that opportunity is gone. That said, you normally find that most allowances are refreshed again in the following tax year. But the people that make the best of them, the ones that do the best financially, are those that can use their appropriate allowances year after year, rather than just once. The allowances are individual. So if you are part of a couple, you each have an allowance, and of course you can double up the benefit between you that way. So as Maria said, we've got 6 weeks or so now to the end of the tax year. So let's have a look at some of the allowances that are still available to you that you may not have made use of so far. So we'll start with individual savings accounts, better known as ISAs. And this is an allowance that allows you to save money for your future with tax-free returns. So we'll have a look at the different types. As I said, all the ISA allowances are individual. So if you are a couple, you can double up and you can each use them. So as you can see from the screen, there's 6 types of ISA available. The most commonly used ones, I would say, would be the cash ISA, the stocks and shares ISA, and the junior ISA. So I'll come back to those 3 in a moment, but just to cover the other 3 on the screen briefly, the lifetime ISA is typically used to help people save towards their first house purchase. It doesn't have to be used for that. It can just be used to save for your longer term future, because you can also access the money again after 60 for any purpose. But generally speaking, it's used for people saving for their first house, and you can only open one of these if you're under 40. The Help to Buy ISA is no longer available to be opened, but you may have one already, so you can keep your Help to Buy ISA. And as the name suggests, that was also set up to help people save towards their first house. Now, both the Lifetime ISA and the Help to Buy ISA not only have tax-free returns, but also have a government bonus added as well. The one at the end, the Innovative Finance ISA, that's particularly aimed at people with a very high tolerance for risk in terms of how the money is used within the ISA. It's a much more risky type of investment ISA, and so I won't be covering any more about that one today, but it is available. So coming back to cash ISA then, so this essentially is an allowance that you would use on a bank or building society account. As with any bank or building society account, you'd hope to earn some interest, and that interest, because it's in an ISA, would be paid tax-free. When interest rates are low, that's a less valuable allowance, really. And the main reason for that is not only because you'll earn lower rates of interest and therefore you'll save less tax in the first place on your interest, but also because most people today have either a £500 or a £1,000 allowance that you can earn interest tax-free from savings anyway, even without using an ISA. So to earn £500 of interest at current interest rates, you'd need to have something like £100,000 or more in savings accounts. So you can probably, in most cases, get your interest tax-free without needing to use a cash ISA allowance. But if you have got higher savings, or if interest rates go up much in the future, then that cash ISA allowance becomes more valuable in terms of the tax it saves. Second ISA on the screen there, stocks and shares ISA. So this isn't a bank account, this is an investment. And as a result of that, the value fluctuates over time. It goes down and it goes up. So it's better suited to people that can invest their money for 5 years or more, because that helps overcome the fluctuations that you'd see on this type of investment. All the growth within an ISA is free of tax. And if you choose the type that pays out a regular income, then that income is also paid free of tax, irrespective of the tax rate you normally pay. So even if you're a high or an additional rate taxpayer, the income will be paid out to you tax-free. And the last one we haven't talked about, the junior ISA. So this can be either a cash type or a stocks and shares type. It has to be opened by a parent of a child under 18. But in terms of contributions can be made by the parent or by grandparents, or in fact anybody else. But I think most typically would be parents or grandparents. Each child can have one junior ISA per tax year, but various people can contribute to that junior ISA. Now, in terms of contribution limits, each type ISA has its own contribution limit. So the lowest being the lifetime ISA, which is £4,000 in a tax year. The junior ISA is £9,000, and the cash ISA, stocks and shares ISA, and the innovative finance ISA all have an annual allowance of £20,000. Now, all adults have a total allowance of £20,000. So if you were using a lifetime ISA, for example, with a limit of 4, you can make up to your 20 in one of the other types of ISA. This is a use it or lose it type of allowance. So if you don't use your ISA allowance by the end of this tax year, the allowance for this year is lost. And if you do make use of it, you then keep the benefit thereafter. So once you put money into one of these ISAs, the money grows tax-free for however long you keep it there. So it isn't just for the year you put the money in, it's for year after year after year if you keep the money there. So adding to the ISA on a regular basis through several tax years can really build up a good tax-free lump sum. The other thing about ISAs is you can transfer between them. So you could, for example, if you have cash ISAs now, you could transfer to stocks and shares ISAs. And as well as the money being transferred across, the allowance that you've utilised would go with it. So all the money you move into the new ISA would immediately be tax-free, even if it's above this year's allowance. So moving on to our next slide, Lee, if you could move the slide on, we'll have a look at whether your tax year end ready with regards to ISAs. So first point on there is fairly straightforward. Are you maximising your ISA allowance? As we said, everybody's got their own individual allowances of up to 20,000. Are you making the most of that? Secondly, as we said, they're individual. So if you are part of a couple, you can each use an allowance. So between two people, you could invest up to £40,000 before the end of this tax year and have it tax-free returns thereafter. And it's not long, of course, till the new tax year, which will bring another 40,000 allowance between you as well. We talked about junior ISAs. So if you have children under 18, have you thought about setting up a junior ISA for them? You don't have to save the full 9,000, but of course that's the amount you can save up to. And it may be that grandparents would like to contribute as well. So that's a really good way to help build money up for the child's future in a very tax efficient way. And children themselves who are aged 16 or 17, they can open their own junior ISA. They could also choose instead to open an adult cash ISA with up to £20,000 in cash. So there's quite a lot that can be done with ISAs before the end of this tax year. Whilst we're talking about ISAs, there's another allowance which could be relevant here as well, and that's your capital gains tax exemption. Now, if you're already an investor and you've got either a unit trust, an OEIC, or a general investment account, you may realise that the returns on those investments are taxed. So if you haven't used your ISA allowance with new money so far this tax year, it is possible to move money from one of those investments across to an ISA to make the returns tax-free thereafter. Now, when you do switch money across, any gain that you've made on the amount that you move across, so let's say it's the 20,000, any gain would then be subject to capital gains tax potentially. But we have an annual capital gains tax exemption of £12,300 each in this current tax year. So what that means is, as long as the gain part of the money you're switching is not more than 12,300, you can move that money across in full with no tax to pay. And from here on, it's then in an ISA and will grow tax-free rather than being taxed. Now, if you don't move your money across from one of these investments to an ISA, eventually, when you do come to cash your investment in, if it's made a really big gain, you'd only have the one capital gains tax allowance in the year you make the encashment. So it's quite possible that you would face a fairly chunky tax bill, which if you actually use your ISA allowances each year to soak up those gains through using the capital gains tax exemption, then when you do come to finally cash in, hopefully you've avoided all that tax that might otherwise be building up in the meantime. So there's the capital gains tax exemption, which is worth giving some thought to. Now let's look at another allowance, and that's your pension allowance. So pension allowances can be a little bit more fiddly and a bit complex, and we usually recommend, therefore, that if you are looking to set up a new pension or to top up an existing pension you've got, that you do take some advice. And there's two reasons for that, really. One is to make sure you can maximise the full benefit of the allowance you have, make sure that you understand what your allowance would be and make full use of it if possible, but also to avoid overfunding. If you breach an allowance, you could end up with a tax penalty as a result, which kind of, completely backfires what you were trying to do in the first place. So advice is usually sensible when it comes to pensions. The tax allowance itself, the pension allowance, can work in one of three ways. So if you've got your own personal pension, then you'll get tax relief, which means extra money is added to your pension contribution for you via HMRC. If you pay into a pension through your employer's scheme, then the allowance works in a way that you actually pay less tax on your take-home pay. So it brings down your actual tax cost, so you take home more. And thirdly, if you are paying into a personal pension and you are a higher rate or an additional rate taxpayer, it's quite possible that you'd be entitled to a tax rebate at the end of the year. You'd need to claim that through your tax return, but you may well get some money back. Now, once you've got money in a pension, then it grows tax-free. So not only have you got added money going into it, typically, but it then grows free of tax thereafter. And any UK individual up to the age of 75 can contribute to a pension and use the pension allowance, even if you've already retired. So even if you're not working, it's still possible to make use of the pension allowances. So if we look at the slide here, just to illustrate how the pension allowances work. So if you look at the piggy bank on the left, the top left, your payments go in, so you make your contributions. Underneath that, you'll see the tax relief. So that will either be, as I say, a form of added money going in from the taxman himself. If you do it through an employer's scheme, then your employer is obliged to contribute as well. So you'll have more money added by the employer. You probably wouldn't otherwise get paid that money if you don't pay into a pension for it. So it is money that is essentially free extra money for you. And then all those three contributions hopefully will grow in the long term. So each of those get their own growth as well. So you really can build up a very healthy sum in a very tax efficient manner using your pension allowances. If you look on the right hand side, you'll see that the typical annual allowance for this year is £40,000. But that is limited by the size of your earnings. So if your earnings are lower than 40,000, you would be limited as to what you can put in as to the maximum of your earnings for the year. If you actually earn a lot more money, then you may find that your allowance comes down below 40,000. So there is a point reached where if your earnings are particularly high, the allowance starts to drop. And this is again where it's important to take advice to ensure that you don't end up paying more than you're allowed to into a pension and then find you get a tax penalty. You'll also see on the slide something called the lifetime allowance. This is the maximum you can have in a pension plan before there is a further tax charge. So if you're starting afresh now, which is a long way to go, if you've already got pensions, it is an allowance that any advisor would make sure you're not breaching if you continue to pay into a pension. And you'll see in the white box there, the text just reminds you that, as I said, if you haven't got any earnings yourself, you're still allowed to make a contribution. That contribution is limited to £3,600 per tax year. And of that £3,600, HMRC will contribute £720. So there's £720 extra that will go into a plan simply because you paid into a pension. So if you're under 75 and you haven't used a pension, it may well be something to look into doing. Now, this is an allowance that isn't necessarily lost at the end of the tax year. In some situations, you can carry forward any unused allowance for up to 3 more tax years. Again, it is a bit complicated, so it's something that's probably best to take advice on. But there's a facility called carry forward, which does allow you to make use of some previously unused allowances in certain situations. But if you haven't used the allowance up in the 4th year from now, then it definitely does get lost. So you have 3 years to use up any unused allowances, and that rolls on year after year as such. If you're a limited company owner, then there is a way you can make an employer contribution, which would be highly tax efficient for you and your business. It would allow you to take money out of your pension and out of your business and put it into a pension, where the company would see that as a business expense and therefore save corporation tax. And if you did that instead of taking extra dividends or salary or bonus, which otherwise you'd be paying tax on, the money goes into your pension without any tax being deducted. So it can be a highly efficient way to move retained profits from a company into a pension in your name. And if you haven't been doing that on a regular basis recently, don't forget you've got that carry forward opportunity to go back possibly up to 3 years and make use of allowances that you haven't used in those 3 years. So the slide in front of us now is just checking whether your tax year end ready. So talked about using your full pension allowance if possible. Make sure that you are if you can afford to do so. We talked about carry forward and the fact that it's possible to sometimes go back up to 3 years and make use of allowances that you didn't use before. If you're already in pensions and you're looking now to make withdrawals from pensions, or you're in the process of doing so, it's important to get advice there to ensure that when you draw money out, you're not paying more tax than you need to. You obviously have various allowances, your personal tax allowance each year and so on, which you can use to avoid tax. And with some good advice and guidance, you can withdraw your money from a pension in the most tax efficient method. And then on the right-hand side, you'll see that there are also some other possible benefits when you pay into a pension. So depending on your income and depending on your situation, these 3 benefits could be possible. So if you're up in the high rate tax band or the additional rate tax band and you make a pension contribution, you widen your basic rate band. The impact of that is it brings down the tax that you pay for that year. The second one on there is if you're earning over £100,000, you may well be aware that you lose some or all of your personal allowance. Your 12,570 that you can earn tax-free can disappear, or certainly reduce depending on how big your earnings are. Making a pension contribution may well bring some or all of that back into play again, which not only gives you your normal tax relief, but some extra tax savings as well, because you get your allowance back. And thirdly, if you're earning over 50,000 and you have children, you're probably aware that you lose your child benefit or some of your child benefit. Again, if you make a pension contribution, it can bring that back into play. So you may well find that for the year you make the contribution, that you can get some child benefit again. And final reminder on there, if you're not earning, don't despair. As long as you're under 75, you can still make a pension contribution in theory and get tax contributions into that pot for you as well. So that's the pension allowance. Now I'm going to move on to inheritance tax, and I'll pass it to my colleague, Mark.
Thank you, Darren. So just by way of introduction, my name is Mark Collins. I'm one of the personal wealth advisors based in Cambridge, and I work closely with Maria, Darren and Craig. So end of tax year planning does provide other opportunities for more holistic planning, just aside from tax efficient investing. So there are a number of tax year related allowances which in respect of estate planning, which as Darren's alluded to previously, if they're not used, they would be lost. So unlike some other forms of taxes, inheritance tax with some good financial planning can either be partially mitigated or in some cases entirely mitigated. So what is inheritance tax? Inheritance tax is really a tax on the estate of somebody who's died. It usually includes, the estate usually includes anything to do with their property, possessions, investments and any money. Probably most notably by its absence, however, are pensions. So pensions are, monies held in pensions can be bequeathed inheritance tax free and wouldn't necessarily form part of somebody's estate. On the right hand side, you've got an example of a calculation which shows how the mechanics of inheritance tax work. So if somebody dies with an estate valued at 625,000, they would have a threshold or a nil rate band of £325,000. Anything over and above that would be taxable So in this case, £300,000 is the excess, and that would be taxed at a rate of 40%. The other allowance that is available, and it's not been included in the slides, is to do with your main residence. So on the proviso that your main residence is left to your direct descendants, each individual potentially has up to another £175,000 on top of that inheritance tax threshold, thereby lifting that threshold to £500,000. Important just to note that obviously there's no tax to be paid where the estate is below £325,000 on the nil rate band, where everything is left to the surviving spouse or civil partner, or where everything above that threshold of £325,000 is left to an exempt beneficiary such as a charity. One of the things to also note is that if a married couple, if the first of that husband or wife to die would or doesn't use that nil rate band can be transferred across to the surviving spouse. When the surviving spouse then passes away, their estate can benefit from a threshold of £650,000. It is important, however, just to note that personal representatives or executors do need to claim both sets of allowances for that to be applied. It doesn't happen automatically. If you could move the slide on, please. So in terms of, there's a number of allowances and thresholds available. So please remember, each tax year you can give away some money or possessions free of inheritance tax. The well-known exemption is called an annual gift exemption. That allows you to give away a total of £3,000 worth of gifts each tax year, and they're not added to your estate. Again, important to know that where you gift money or money's worth, that can be up to £3,000 for one person, or that £3,000 would have to be split between a number of people. So the allowance is relevant to the individual, not to a number of £3,000 gifts. Also important just to note that if you've got any unused exemptions from previous tax year, you can carry those forwards, but they can only be carried forward for 1 year. There are a number of other gifting allowances available. So one of those is called the small gift allowance. Any number of small gifts up to £250 can be given to any number of people, as long as they're not given to the same number, as long as they're not given to the same people that the £3,000 threshold is applied to. Also relevant are gifts for weddings or civil partnerships. So depending on the relationship between the recipient and the donor, that can be up to £5,000 if your child is getting married. If it's a grandchild, it's £2,500. Otherwise, it's £1,000 for everybody else. And perhaps the most underutilised exemption is this ability to gift money away from surplus income. So the only proviso is that that doesn't affect any of your normal standard of living. So again, by way of an example, if your income is 30,000 and your living costs and maintenance costs are 20,000, you can give away the surplus income, £10,000. Again, that's immediately outside of your estate, and the gift just has to be regular, so at least annual in nature, if not more frequently. Also important to note that no tax is due on any gifts if you live for 7 years after the date of giving them. That's known as the 7-year rule. If you're gifting money to a trust, there are some nuances there, and that 7-year rule sometimes applies, but sometimes doesn't. So again, we would suggest that you take financial advice in that respect. If you do die within 7 years, then there is inheritance tax to pay. And the amount does depend on the allowances available and obviously when you gave the gift and how much the gift was. So that's allowances and thresholds. Lee, if you could move the slide on, please. So the other point really just to note in terms of other opportunities prior to the end of the tax year is that the government have recently introduced legislation in terms of social care reform. Again, it's been widely publicised, and the way that the government plans to pay for this new reform is really to introduce a social care levy, which will essentially mean that from April 2022 onwards, there'll be rises in both dividend taxation and national insurance contributions. So there will be a 1.25% increase on national insurance contributions on earned income. That will apply to both the employee and the employer. It also applies to Class 4 national insurance contributions, and equally dividend tax rates will rise by 1.25%. The government plan to use that increase in the taxation to ring fence the funds to pay for health and social care costs. Dividend tax is applicable on dividend income above a £2,000 dividend threshold. So anything where dividends are paid and they're below £2,000, they're not subject to tax. Equally, if dividends fall within the personal allowance of 12,570, again, tax won't apply. Also, in terms of planning, so any dividends on assets held in ISAs, and again, any dividends held in assets held in pensions will be excluded from the dividend tax. And just in terms of the rates themselves, so from the tax year starting on the 6th of April 2022, basic rate dividend tax will be charged at 8.75% as opposed to 7.5%. Higher rate dividends will increase to 33.75 instead of 32.5, and additional rate dividend taxpayers will be subject to a tax rate of 39.35 instead of 38.1. So most importantly in this respect, what I would say is where pension contributions and opportunities to take dividends before the end of the tax year, they should be utilised as part of an overall tax year end planning strategy. So that's my piece in terms of inheritance tax and national insurance and dividend tax. I'm now going to pass on to my colleague Craig Crawford, who will talk to you about creating your own financial plan.
Thank you, Mark. Hi, I'm Craig Crawford. I've been with Schroders Personal Wealth for approximately 18 months now. So I'm a personal wealth advisor with the majority of my clients around the Cambridge and the Essex border. Slide, please, Lee. So what I'll be discussing today is a personal finance planning strategy to help you to achieve your goals or your future goals. So this is a methodical planning process for you to work through. So if you've not spoken to us before and would like our help with the strategy, then we can provide you with another perspective, so you can make decisions from an informed position. Then once you are happy with the strategy, we will then implement your plan for you. So, slide please, Lee. So what I'll do now is I'll just talk through each stage in detail. So the first step is to really think about what you want to achieve. So what do you want your wealth for? So for some examples could be to pay for your children's education costs, private schooling, university fees, or maybe put towards a new home. It may be a broader goal to increase your choices in the future, or for that financial freedom for more holidays each year, or to work less hours, or maybe to retire earlier. You may want to invest now with an aim to providing a future income to bridge the gap before state pension age. So when we help our clients, we typically explore 4 key areas. So this can be a good start point for you too, to think about your own life plan. So the first area is your career. So what is your desired retirement age? Any changes over the next 5 years? For example, an increase or a decrease in income levels? Then consider your family circumstances. So who is financially dependent on you? Partners are obviously dependent on each other until you both retire. Children until at least 18 years old. So areas such as, what you want for your children and your grandchildren. What does legacy mean to you? Is your will up to date? Do you have powers of attorney in place, or any potential future inheritances? The next area we'd look at is your lifestyle. So consider what's important to you. What do you enjoy doing now? What will change in retirement? New cars, holidays, weddings? Will you be traveling more, traveling less? Think about your health too. So what is the plan if you were to need long-term care? And then finally, property. So any plans to move or downsize your home, renovations you have plans, for example, extensions, loft conversions, or any future holiday home purchases. These are all areas for you to consider. So slide please, Lee. So if you decide to seek professional advice, then we use cash flow modeling software, and this is a fantastic tool. It allows us to stress test your financial plan. So for example, we could look at identifying any shortfalls in retirement, or how early you could potentially retire based on your income needs. We could include assumptions for inflation, potential growth of investments, or we can model what would happen if they either were to pass away or you couldn't work, for example. But again, it's all based on your aims and your objectives, which is fundamental to your plan. So this is real goal-based financial planning. Slide, please, Lee. So the next step relates to gathering information. So this is about collating everything relating to your financial circumstances. Now you can carry out a review of the situation yourself, or we can help you. We can take everything apart and essentially we're going to put it back together again for you. Now your priority should be financial protection. So think about if the worst were to happen, what is the plan? For example, protecting your dependents by setting up life cover, your mortgage protected if either were to pass away. Think about things like critical illness and what you may need, or if you cannot work due to long-term illness or injury. Then examine your current financial assets. So we thoroughly investigate each area with the clients, but you can also review yourself. So accurate income levels, bonuses, benefits in kind, overtime, all your bank balances, any cash holdings, assets such as premium bonds. Review all financial holdings for suitability. So investments, ISAs, investment bonds, funds, and the key area is pensions, already covered by Darren. So final salary, money purchase schemes. This is a great time to sort of dust off the pots of money or to gain illustrations from the providers. Now, if you opt for professional advice, then we help our clients by gathering the information for you. So you can complete what's a letter of authority, so then we can speak to the providers on your behalf. However, they are your providers, so you can ask for all of the information when you need. Tax and investment allowances is obviously also key, as mentioned by both Darren and Mark. So work out what you have remaining. Obviously, you don't want to lose those valuable allowances in April. Thinking about estate planning too. So identify if you have that inheritance tax liability, and explore your options to mitigate. So options you can do yourself, or some options you can do yourself, and some we can help you. And if aiming to grow your wealth through investing, something you're looking at, then think about risk tolerances. So your attitude to risk, your ability to take loss in a major market downturn, and then your investment preferences too. Where do you want your money invested? Again, this is what's important to you. This is a key part of professional advice, but you can consider for your own plan. So I've given you lots of information there, but it's essentially about gathering information, then establishing your current position, identifying the gaps to plan a suitable way forward. Slide, please, Lee. So the next part is about your financial plan. Now you can think about this area as pots of money. So I'll speak to my clients about 3 separate pots. So pot 1, this is your emergency cash. So this is ring fence capital. This will be a minimum of 6 months expenditure. For example, I don't know, boiler needs replacing, car breaks down, roof blows off. Pot 2 is planned spending. So over the next 5 years, key events such as holidays, new car, children's weddings. Again, this is all ring fence money. But anything you've got left, this is pot 3. This is essentially dead money. Now, if it's kept in cash for a long period of time, it's exposed to the effects of inflation too. Now, if you're in the accumulation phase of life, your aim is to get this money working for you, or to at least aim to preserve from inflation. We're also aiming to grow your wealth to meet those future goals. If you're in the legacy planning phase of life, then passing on wealth tax efficiently, you could look at options to potentially remove the money from your estate, so more wealth is passed to the next generation. When we're talking about protection, so as previously mentioned, this is putting a safety net in place. So if the worst were to happen, you and your family have that financial protection. Now, for professional advice, it typically takes 2 or 3 meetings before we formally present your financial report. What we do is we talk through the plan together to explain our advice, what we recommend to help you achieve your financial goal. Slide, please, Lee. And the final step is to review the plan each year. So once you have your plan, you must monitor it. So your circumstances may change. You want to keep on track towards your goals. So if you want professional advice, you could think of it like having a lawyer on retainer. You have that financial advisor you can call, direct contact there to help. Or if your circumstances change, we can set up ad hoc meetings. We're essentially monitoring the solutions to ensure they stay suitable for you. For example, make top-ups for investments or risk strategy changes. So we conduct annual reviews, and in the nicest possible way, this forces you to put that time aside each year, get an hour in the diary to check the plan, to ensure you're still on track, and then make any changes that are required. And also you can hold us accountable each year too to show the results. We can reflect on the year, discuss the markets, and we can show you how this has affected the performance. So in summary, if you don't know the destination, then how do you know which way to go? It's like anything in life, you can do it yourself or you can seek professional advice. We're here to pass on that expert knowledge, if you want to help, of course, to show you the options and then help you implement your financial plan. So I'll now hand back over to Maria.
Thank you, guys. Some really great content and considerations with top tips there for us all to be thinking about. I would like to spend the final couple of minutes talking through what support is available for each and every one of you on this call. I want to start off by touching on financial wellbeing in the workplace, because when we actually talk about our finances, there's a strong correlation between our financial wellbeing and the impact on our mental wellbeing. This is an area that Schroders Personal Wealth have done a lot of research on. So we can see some of the content on the slide. A couple of the key ones that I want to pull out are that 48% of us regularly stress about our finances. Although 1 in 2 of us are feeling that stress and pressure, only 3% of us would share that with our employers, which is incredibly low. So with half of us worrying about our money and nearly 1/3 of us saying that it impacts our work. So for those of you on this call that work in a business or own a business or have employees or teams in your remit, that's 1/3 of your employees or colleagues that are saying this is really impacting them in the workplace. So one of the things that we can do as a company with you is work to build an engagement plan to help normalise the conversation of money within your organisation. So we do that in 3 ways. So first of all, we can provide education, so you can access to materials that people can access in their own time to build financial foundations. So this could be materials such as looking at our wealth lens on our websites, articles, blogs, national seminars that we host, so we can share that with you. The second piece is through guidance. So that's exactly like sessions today, where we'll be hosting a webinar or a seminar for your friends, your colleagues, and where we can talk about key aspects of our finances, whether that would be either protecting our wealth or investing for the future or planning for retirement or tax year end, such as this one here. So we can create that safe space within your organisation for your friends and colleagues to talk openly about their finances. Ultimately, it is about advice, because that's what we do. We have advisors based right around the UK. So if any of you or your friends and colleagues want to have that more one-on-one conversation with an advisor such as myself or my colleagues about your personal circumstances, we'd be more than happy to do that and to facilitate that through the workplace. So moving on and looking at the life's wealth journey, talking about advice, these are some of the questions that I frequently get asked by my clients. So if you're on this call and you're sat on the left-hand side, I'm still building my wealth, I'm employed, I'm paying into a pension, I'm looking at growing my money, you may be asking, you know, what help's available to me? Can I do it myself? How do I make my money work harder for me? And some of you on this call may be approaching the middle, or you'll be actively looking at retirement planning. So when we're talking about retirement planning, we don't mean next year. These are conversations that we need to be having at least 10 to 15 years out. So we've got time to answer those questions and we can put those plans into place. So this will allow you to have enough money in place to be able to fund exactly what it is you want to do when the time feels right and when it comes. So the questions and support don't stop there. As we enter into retirement, we look to utilise our wealth in a tax efficient manner, as we've spoken about throughout the session today. So again, as advisors, this is where we're here to help support you through that journey. So moving on to the next slide and looking at the support available, there are lots of different dedicated support out there, but part of the offering in terms of the Cambridge network and to anybody on today's call, and for those of you that are not clients of Schroders Personal Wealth, we do offer that free financial health check. It's a half an hour, no obligation conversation with myself, one of my colleagues, a chance for you to ask those questions that you may have, and also for me to really understand a bit more about you. And ultimately, is financial advice, are you going to benefit from it? Is it going to add value to you wherever you may be at the moment in your financial journey at that point? So you can book through the dedicated link on the Cambridge network. So don't forget, there are a number of dedicated resources available to you as well to help your financial well-being, as you can see on screen. And just a last point as well, which would be really, really helpful and great to establish some relationships for any accountants or tax specialists and solicitors on today's call. It would be great if, you know, if you could reach out and connect, as I often get asked in meetings, could I recommend someone more locally in the Cambridge area? So it would be great to establish some of those relationships and connections. So really that's it from me. So thank you. We'll now open up for questions. We'll go through as many as we can, and we'll get back to you individually if you're happy to leave email addresses, should we not be able to answer them all in today's call. But I believe we have posted our email addresses in the chat as well. So if you do want to reach out, then that way we can answer any questions you may have more confidentially if need be. Thank you ever so much.